The purpose of this webinar is to give a brief overview of the 504 loan program and also who we are at Mountain West Small Business Finance. Mountain West Small Business Finance was established in 1980, and we are what is called a certified development company. Essentially what that means is that we have been chartered by the SBA to administer the 504 loans. Throughout the United States, there are various certified development companies, at least one in every state. And we've been doing these since 1980. Mountain West Small Business Finance operates in Utah statewide and also Wyoming statewide. The Wyoming statewide portion of our operation is new as of 2018, and we are excited about working in the state. We are also allowed to do any loans bordering Utah as well. So that allows us to go into Idaho, Colorado, Clark County, Nevada, and also Arizona. We have lending offices in Logan in northern Utah. Salt Lake City is our headquarters, Orem in Utah County, St. George in southern Utah, and we also have a corporate office in Evanston. To give you a little bit of an idea of how many loans Mountain West Small Business Finance processes every year in comparison to the nation, nationally, the SBA 504 loan program approves over 5,000 loans a year, and in 2018, that equated to $4.7 billion of loan funded. In 2018, Mountain West approved 192 loans, or about $13 million a month in approvals, adding up to $156 million for the year. Now a short introduction on our Wyoming production team. Our production team is headed by John Evans, who is our president, and being serviced by Judd Blakesley, loan officer, who covers all of Wyoming and northern Utah, and Mike Oliver, who is our business development officer, also covering northern Utah and all of Wyoming. Now, without further ado, I'd like to introduce you to Judd Blakesley, who will be our narrator for the remaining portion of this webinar. Judd?
Thanks, Danny. Appreciate that intro and background to the Mountain West and the SBA 504 loan program. Thanks everybody who's joining us. We're going to go through, talk about what is the SBA 504, the loan details, how we work with banks and credit unions, and the overall loan process. So all those listening, whatever your role is with your bank or credit union, this will help you understand how loans are approved, how the SBA works, and specifically, if you have any projects that you've been looking at, how it would apply and relate back to your customers. So we'll first start out with the history of the 504. As it began in 1980, Danny mentioned that Mountain West started, and every state has a CDC. Well, the SBA started with an initiative where they created two SBA loan programs, the 7A and the 504, which many of you have probably heard of. The SBA has a great knack for naming things. So naturally, the SBA 7A loan was their working capital business acquisition loan program. And then the 504 was created specifically for the purchase of owner-occupied real estate and equipment. So the SBA started out with these two loans and provided them as tools to lenders so they can go out and help business owners provide more access to capital. The SBA is a government loan. The SBA 504 is a government loan created specifically for the purchase of commercial real estate and equipment, whether that is for the purchase of land and new construction, purchasing an existing building, new or used equipment, or refinance of existing debt on commercial real estate. Here's a breakdown that shows you percentage-based the SBA 504 loan requires the participation of a bank or credit union. A common question a lot of business owners will ask is, you know, why isn't the SBA, if they're providing these great terms, doing the whole loan themselves? And the reason is the SBA wants this loan as an incentive for lenders to use. So if you have a project where a business owner wants to purchase a building, an SBA loan allows them to purchase it with just 10% down. The lender, the bank or credit union, lends half the project, and the SBA lends 40%. So you can see on this graph, this chart, the bank or credit union will always provide 50%. The SBA actually maxes out at 40% of the project, and then the big incentive is that 10% down. SBA's vision, this is taking a step back to the philosophy of the SBA. They want businesses going from leasing to owning real estate, as they see that as a way to get a business more established, more long-term. So they consider that building Main Street. So the SBA's vision and purpose is to encourage businesses to buy their building. And so typically you look at a down payment at each of your organizations if they went directly to you. And most common that we've seen is 20 to 25% down. So the SBA comes in as an option where for 10% down, they can jump into buying a building, you know, 2, 3, 5 years sooner than they would having to save up that 20% down. So here are the big benefits when talking to customers. And you can look at this and see, and as you've probably worked with the 504 in the past, the success of the 504 has been the low down payment and the long-term fixed rate. Briefly touched on that low down payment as 10% down, and we'll go through and discuss how the SBA has a below market fixed rate, which is also an incentive. As a reminder, as we're going through these slides, you can either jot down questions, look to the features as you're logged in. You can email us after. Any questions you have, be sure to just think those through and pass those on, as we'd love to answer those. Low down payment, fixed rates. Yes, you heard that correctly. Most lenders will require 20, 25% down, as we talked about. And for business owners, coming in at 10% is very sweet. The lower down payment is intended as a tool by the SBA to help businesses get in their building. The other side part is many that we see do have the 20 or 25% down available, but by coming in with 10% down, they can now refocus that extra cash that they would have used to hiring new employees, growing, keeping it in savings. So that's the other side incentive to the low down payment. Not only will it get them into a building quicker, but they can preserve cash and use it for other ways to grow the business. So while we're talking about that down payment, with the SBA, they have different ways that you can come up with the down payment. The loan approvals we review, we first look at, do they have the funds available, either personal or business cash. We look at their personal financial statement or balance sheet and say, okay, do they have that 10%? Now, we verify the down payment at the very end, once they're in the building or the construction is complete. Now, there are different methods that, as long as we identify them early on, we can be creative and find different ways of coming up with that down payment. First, easiest is cash from the owner. The next is the SBA does allow them to borrow it. So it can come either from a line of credit on the home. It can be, they can tap into other assets. The bank or credit union, you can offer them a line of credit to the business. Seller carrybacks. So that is where the seller will agree to say, okay, they'll be paid over time. So they set up a repayment there. We like the borrower to still come in with half the down, but If a seller's willing to carry back and accept payment over time, then that's great. That saves cash, and so the SBA does allow for that as well. Now, if they already own the property and they're expanding or building another project, we can use the equity in their existing real estate towards that 10% as well, which is nice. So this ties into the classic win-win-win we've always heard. The win is borrower gets low down payment, low fixed rate. Bank, credit union, as we'll talk about, they win because they're helping more customers get into buildings. And another win is the SBA is in a second lien position. So bank, credit union always will have a first lien priority at half the cost for a project. Okay, time to get down to the nitty-gritty. What can the 504 be used for? So scan over this list. This is the general overview of the categories that the 504 can use. You can purchase existing buildings, you buy land, build new buildings, purchase equipment, refinance existing debt, you can expand your building, you can do a cash out refinance. Now, any of these costs that go into getting the building, your interest reserve, closing, origination fees, contingency for construction, all of those can go towards the project and actually count towards your down payment. So if the borrower's already paying for an appraisal fee, architect fees, engineering, then those will all count towards that 10% down payment. You'll notice what's not eligible. The SBA wants to keep this loan for fixed assets. So working capital, inventory, other current assets, goodwill, buying a business value are not eligible. And that's where the SBA 7A loan comes into play. And that loan can always work in conjunction with the 504. I'm going to show you a series of just a few projects over the last year, different types of businesses. So here's an architect firm. They built a new building, $1.6 million was the total project. Dental office, they expanded, built on, and renovated where they were at. Again, close to the same, $1,650,000. For dentists, they're able to include, if they want, their dental chairs, equipment, any of that build out. So furniture, fixtures, equipment are all eligible to be wrapped into a building loan. For most lenders, they like to see equipment or short-term assets financed separately, but a nice incentive of the 504 is you can wrap those in to the long-term loan and have those payments spread out over the 20 or 25-year period. Here's a picture of a construction project. This is for a manufacturer in Utah County, and these guys were able to build a new building. They maxed out where they're at. They needed more warehouse space and room to build their product. And so this was a $2.6 million new construction. In Utah, we do see a lot of manufacturing, especially in the northern part of the state. We have a variety of machine shops, plastic injection molding. So here's an example of just heavy equipment. Now, it is eligible to purchase equipment through a 10 or 20 or 25-year fixed rate. The key is that that equipment has to have a useful life that matches that term. So most common is a 10-year term loan, but if the manufacturer says it has a 20 or 25-year useful life, then we're able to finance it and spread it out over that longer period. So here's an example, $118,000 for this piece of equipment. It could be financed separately, or if they're buying a building, it could be included with it. The SBA 504, the Small Business Administration, draws a line in the sand where what they consider owner-occupied projects versus investment properties. What the SBA does not want to do is finance investment properties. They want this loan to be for small business owners And that's where we come back to that Main Street America. They want them to be able to buy buildings. So that's where this loan program is specifically for small business owners that will be occupying their space. So first off, we'll go to the bottom part, existing real estate. 51% must be occupied by the business. What that means is someone comes to you with a business owner, let's use an example, we just did a project for a plumber. So he wanted to buy a bigger building. So he went to his lender and said he's got a space he's identified, but there's already a tenant in there. For him to be eligible, being that it's an existing building, the SBA says, we know every building is not the same. It's not custom made for you. So we want you to occupy at least 51%. So this plumbing company was able to buy this building, keep a tenant in there because they occupied 51% of the space. The way that's verified is, well, it's confirmed through the appraisal where once we get the appraisal, it'll show the square footage. And if a tenant is leaving over, within a year, and that allows the owner to occupy the 51%, SBA works with that. Now, if a small business is looking to build a new building and they come to you with plans and they're discussing the option of having tenants to build a building and have ongoing lease income, the SBA then takes a step in and says, if you're able to build a building that's custom for you, we want a building that you can grow into over time. So you'll see here, they want you to occupy 60% at the beginning, and then over time, within the next 3+ years, they want the option available for you to occupy another 20%. Whether or not that does happen, they at least want that option there. So that's, if it's a new construction, they don't want a long-term tenant with a signed long-term lease from the beginning. They just want you to occupy that 60%. Now, let's talk about the interest rates. So the SBA has a below market fixed rate. If you've worked on a 504 loan, then you've seen these rates over the years. If you're looking at one of your first projects, here's how it works. So the SBA gets an approval up front, and we designate whether or not the borrower wants to go 10 years, 20, or 25. Depending on that term, they have a different rate designated to them. And so it is a fixed rate for that full period. For years, since the program started, there's a 10-year option and a 20-year option. Well, just this last year, the SBA approved the 25-year option, which has been very successful. And every month, once a month, these rates are fixed for loans that are funding. That rate is not locked in until the SBA funds. So here you can see the 20-year rate right now is 4.75, the 25-year is 4.87, the 10-year is 4.64. I just mentioned that the SBA rate does not lock in until the SBA funds. A nuance to this loan program is that the SBA gets the approvals up front. So the lender and borrower know the SBA has approved the loan, and what they require at that point is that the bank or credit union funds and actually covers the SBA portion initially. And it's called an interim loan. So the SBA approves the loan, and the lender issues an interim loan which covers the SBA and bank or credit union portion. The reason for this interim loan is that the SBA takes 30 to 60 days to confirm the funds and secure them, just to secure the funds and lock in the rate. It's important to point out here that as lenders, you do take additional risk, as it's not normal or conventional for you to do a 90% loan. But because of the SBA approval, you're allowed to extend that on a temporary period. And so you'll see here, initially at the point of approval, you can go to close. The bank will cover the SBA's portion, and then 30 to 60 days later, the SBA comes and pays down the bank. And it's okay and very common for lenders to take additional collateral during this 30 to 60 day window. Let's dive into an example. So Initech, a software company, has been leasing. Most common right now with the rates having been, towards historical lows in the 4 and 5% range. Many leasing companies have been leasing or looking to buy buildings. So Initech Software had been leasing. They've been in business for a few years and ready to relocate and buy a building. So first is we look at the purchase price, $630,000. $150,000 towards improvements and $20,000 towards soft costs. That can go to bank fees or any costs associated with securing the property. Project breakdown. Again, the bank or credit union lends 50%, so your long-term loan will be for $400,000. The SBA, $320,000. And then the borrower's portion is $80,000. So when looking at this, we say, okay, as long as you come up with $80,000, then you're able to use the SBA 504 as a loan. Now, with every loan, there are fees involved. The bank has fees, the SBA has fees. What's nice about the SBA is they're percentage-based, so no matter who is borrowing, it's based off of the size of the loan with a flat SBA attorney fee of $2,500. So here we look at, and they're based off of just what you borrow from the SBA. The SBA portion for this example is $320,000. And so these are percentage-based fees that are off of that $320,000. Typically, we'll say the SBA fees are 2.65%. That generalizes what the cost is for the SBA loan. It's nice to know that this is a government loan, but it is a zero subsidy loan program, meaning that the SBA set it up and the success of this program has been that there's no cost to the government, that it's a self-running loan program. So 2.65% of those fees. And say, not bad, but wait, there's more. The SBA, again, with the initiative to preserve cash for the borrower, these fees are wrapped into the loan. So we point them out, and it's always, we'll send a spreadsheet at the beginning of every loan to show you what the fees are, but they're wrapped into the loan. So the borrower does not have to come in out of pocket and pay those at closing or along the way. They're wrapped into the loan and they're just paid off over time. With the long-term below market fixed rate, really only takes a year or two for any borrower to recoup these fees and then have long-term savings with this loan. And with that, even Hillary can smile. Okay, so what types of loans, what size of loans can we do? The SBA, about 4 years ago, upped their size standard to $5 million. For years, they were at $1.5 million that the SBA would lend. Then it went up to $3 million. Then now it's been at $5 million, which would be the SBA portion. So we've gone from seeing projects around $3 or $4 million up. Now that we can go $5 million, we can actually do projects up to $12, $15 million. So we've done hotels, big manufacturers, assisted living centers where they're $8 to $12 million projects. Just know that the SBA maxes out at $5 million. Now, if you have any manufacturers that you work with, the SBA allows $5.5 million, and they actually allow $5.5 million per project as an initiative to really encourage manufacturers to keep building, to keep growing. The SBA will lend to them continuous. So we have some manufacturers that have $15 million with the SBA. Now, for anyone else that's not a manufacturer and they have maxed out their $5 million, the SBA came with another initiative where you can go green. And if you put solar panels or reduce energy on a project or produce energy by 10%, then the SBA allows you $5 million per project. So just like the manufacturers, they can keep coming back. So we have some assisted living centers, hotel owners that have 3 or 4 projects where they've maxed out, but they've gone green. on their additional projects to continue to be eligible. With every loan, now we're taking a step into the loan process. With every loan, there are 3 approvals, meaning the SBA is going to issue 3 stamped letters to the bank and borrower saying they've approved this, and essentially the funds are set aside for you to move forward. A credit approval, where we review the cash flow, the ability of the business to service the debt. That's the main one. The SBA will issue an authorization. The environmental, every project, we look at the history of the land and determine if it is environmentally sound, and an appraisal. So the SBA wants to confirm that the collateral is available for the project. So common questions you'll be asked or have been asked: what collateral is required? Who has to guarantee? On every SBA loan, the nice thing about the 504 is that it's the commercial real estate, which is the intended collateral for the project, where additional personal homes, personal property are not required. That as long as the appraisal comes in to confirm the cost of the building, that's what the SBA is looking after, and that's the collateral for the project. So who has to guarantee? The SBA, we look at the business, we look at the ownership, and then anyone who has 20% or more ownership is required to guarantee. So if you have a business where it's 50-50, those 2 owners are required to guarantee. And what that means is it's an unsecured guarantee. They're not pledging any personal collateral, but they are putting their name on the mortgage or note with the project. Now, most businesses elect to create a new LLC or a new entity to take title to the real estate, and the SBA has the same formula. Any owner that's 20% or more is required to guarantee. And with that, we'll collect 3 years personal tax returns, personal financial statement, pull their credit, and then they're attached to the loan. The approval process, here's an overview. It takes more or less 45 days. We like to review and underwrite the loan the same time as you, bank or credit union. We want to get the tax returns, review it. We have an internal committee structured the same as a lender, and the SBA requires us to do an internal approval. And once we have our internal approval, we send that in along with a letter from the bank or credit union stating they're reviewing the loan or have approved the loan, so the SBA knows there's a lender on board. And usually at that point, once we send it electronically to the SBA, they'll take 5 to 6 days to review and approve. If they come back with questions, we get back with you and the borrower. That usually may add a day or 2 to the approval process. Overall, when anyone asks, we say it's a 45-day approval process. Going on with what is a part of the project, we've talked about 10% down. The SBA has 2 rules which would increase the down payment, and that's if the business is a startup or special use. A startup is any business that's 2 years or less in existence. They'd have to come in with an additional 5% down. If a business is special purpose or special use, it's an additional 5% down. Well, as you've probably seen over the history of lending, a special use varies from lender to lender. And for the history of the SBA, it was a morphine, what is special use, what isn't. From the get-go, to point out there are 2 that are not special use, which typically others think they are: restaurants and self-storage. The SBA does not consider special use, which is great. That means 10% down. Well, the SBA did a great thing, and they gave a list of special use properties. If a project is on this list, it's special use. If it's not, then you're good to go at 10% down. So take a look at this list, and you can look at it and see a lot of these probably surprise you that they are types of properties that the SBA is willing to lend to. Cemeteries, funeral homes, golf courses, hospitals, nursing homes, tennis clubs, sports arenas, movie theaters, all these. The two that have contingencies on them that are very common, worth pointing out, funeral homes. If the funeral home has a crematorium, it's then special use. If it does not, then we can get it in as a general use 10% down. You'll see on the right side, service centers. This is your auto repair shop, your quick lubes. If they have in-ground pits, they're considered special use. If they do not, then they can be 10% down. So an example is if you have a quick lube or a grease monkey, those are ones where if they do those in-ground pits, it's no-go, it's 15% down. But some of them have what's called a zip pit, which is just a variation of the in-ground pit, and SBA has allowed that to be general use. So for any project, if you think it doesn't quite fit the special use, we can always go to the SBA and ask for an exception. So let's look at an example. Common one is a gas station. Gas stations aren't eligible. The SBA wants to look at the franchise or the jobber or the gas oil agreement, and then a convenience store or anything else that's attached to the gas station. Being that it's special use, we'll look at how that additional down payment goes into effect. So here, last gas station we worked on, the land of building was $1,270,000. They purchased some new equipment for $80,000. Professional fees and soft costs, those go towards anything, again, costs that go towards the project. Professional fees can go towards any of the bank fees, any of the appraisal, environmental costs. So we've got a project of $1,870,000. The project breakdown is the SBA requires the bank to be at 50%. Then the SBA will be at 35% because the borrowers come in with 15%. So anytime it's a special use and the borrower comes in with additional down payment, it comes off of the SBA's portion. Another reminder to point out is the SBA is always in a second lien position. So on the actual property, bank or credit union files a first lien, and then the SBA is in a second. Here's a visual breakdown of the funds. Borrower 15%, the lender is 50%, the SBA is at 35%. Now, in that crazy scenario where it is a new business and special use, that means the borrower goes from 10% plus additional 5% for being new, plus an additional 5% down for being special use. So on the bottom right, again, it comes off of the SBA portion, so borrower would be 20% down with the SBA at 30% and the lender at 50%. This would be if someone's building a brand new gas station, it's their first business, the first time starting out, and as a lender, you don't feel comfortable doing it conventionally, you bring in the SBA, it's 20% down, and then we go from there. We've talked about regular, the 504 that's been around for 30 years. That's these new purchases, new construction. The SBA offers two types of refinance. And so we'll look at these briefly. I've got a few examples that we can look at that I think you'll enjoy. The overview of the refinances, the SBA has approved these recently. It is when you're paying off or refinancing a conventional bank or credit union loan, and you want to bring in the SBA. So basically, the SBA would come in, pay down the lender, and the borrower would have the option of they can add in some cash back in that or just do a straight refinance. There's three benefits with the refinance. The first is you're able to lock in that long-term fixed rate. Forever, the SBA was at 20 years. They've just offered a 25-year option. So they can then go from, if you have a refinance where it may be a call in 5 years or the loan's due in 1 year or 2 years, they can re-amortize and spread that out over 20 or 25 years. The next is you can get cash out. So if they're looking to pull some cash, some equity as they re-amortize, the SBA allows for that as well. The third is your equity covers your down payment. So they're able to refinance without any cash down. We just confirmed that there's at least 10% of equity in that property. So refinancing, it has to be commercial real estate debt. What the SBA looks at is that debt's been at least around for 2 years. We can refinance in-house lender debt. So it could be a loan each of you have that's in your portfolio, or if you're looking to win over a borrower and they have a loan with one of your competitors, you can bring them over by offering this refinance where you can bring in the SBA. They can respread their debt with a long-term fixed rate. With rates right now below 5%, it's very attractive. The one thing to note is the SBA cannot refinance government debt. And so that's where it cannot do SBA or USDA. What the SBA looks at to just protect themselves, that they don't want a lender to try to offload bad debt on the SBA, we get the last 12-month payment history and just confirm that they don't have any late pays over 30 days for the last 12 months. If you have someone that's looking to get cash out, the SBA's formula is they'll allow up to 20% of the appraised value as cash back. Okay, here is one of the best examples we were able to find. Taking you back to the 90s, here's a refinance cash out example. Malibu Sands Beach Resort is looking to refinance $3.7 million in commercial real estate. Mr. Carosi, the owner, also knows that he's got some summer help that he needs to get. So he's looking for $300,000 to get cash back in anticipation for that. First thing is we get an appraisal to confirm the equity and how much cash back we can get. So it appraises for $5 million. He owes $3.7 million, looking for $300,000. So we'd say $4 million would be our project that we need to lend. And he has $1 million in equity. So you look at the bottom right, $1 million in equity, that goes towards his down payment. It's confirmed he won't have to come in with anything else. And then we're able to split the difference with the lender. So bank or credit union, you'd be at $2 million. The SBA would be at $2 million. And then he's able to refinance. They'd have a SBA long-term portion at $2 million. Here's another refinance. This is an example of a growing business that is looking to expand. Most common we see are restaurants, but it's anyone that, you know, if it's a dental office, if it's a manufacturer, a hotel, any business that is looking to expand. First thing we like to ask is, okay, in your current location, do you owe anything? Because if we can refinance that in as part of the new project, we can count their equity. So here's an example for Los Pollos Hermanos. If any of you are familiar with them or have eaten their chicken, it is delicious. Everyone is loving Los Pollos Hermanos, and Gus Fring is ready to expand his restaurant. Business is good, and he's looking to grow. So first thing we ask is, what is Gus's debt on his current building? And so he owes $1 million on his existing. It appraises for 1.5. So we instantly know if he allows us to refinance that debt as part of the new project, we can use his equity towards his down payment. So we combine that together, and you'll see on this example, we're able to split the debt of the expansion plus the refinance. We leave his equity, and then he's able to re-amortize his debt. We have a new loan for $3.5 million. So how do you get started? How does it work from here? For any project you're looking to do, first thing we say is you identify commercial real estate. If it's a land, building, equipment, look for the SBA 504. If you have someone that's coming in looking to buy a building, call us, email us, text us. First thing we want to do is just say, okay, what are they looking to buy? How much? What type of business? usually within a minute or two of just talking with you or you and the borrower, we can determine if it's going to be 504 eligible. And what we do is we do have an application. Here is the general checklist on the left that you'll see, but it mainly mirrors what you're already asking the borrower anyways. They've already completed an application for you. We just have you send that to us. We don't need any additional paperwork. We'll get everything filled out and signed later for projects that go. But same thing, we want to underwrite the same as you, and the quicker we're involved, the more we're able to confirm that it would be eligible, and it speeds up our process to just match you. We want to be approving the loan by the time you approve it, so there's no lag time. What we get are copies of the tax returns, business financials, owner financials, and then project cost bids, anything that goes specifically to the project. So while we've gone through, we're just wrapping up this presentation, while we've been going through talking about it, if there are any projects that have come to mind that you think would fit this, the easiest and the preferred way is just to give us a call. We just talk about it, see if it works. And then we also want to get you set up with some of our paperwork, so anytime someone is considering a 504, you've got flyers and applications that you can provide them. Again, low down payment, 10% down, long-term fixed rates. Those are the big incentives. That's the big reason to push. Hopefully that allows you to do more loans, incorporate more business owners, more projects, using this as a tool as a lender. And then again, for the borrower, for those, they're able to get a more predictable long-term monthly payment. With that, for my part, I really appreciate you following the SBA 504 and its greatest and most exciting and fun details. We'll send you this application. Anything we've covered, if you have any more questions on or about, I'm going to turn it over to Danny to wrap this up. Again, our only technical difficulty was with that video. We'll send that out in an email as well. Just want to give you something to look forward to. And then, Danny, over to you.
Great. Thanks so much, Judd. Those of you following along on the Q&A, we've been able to answer the majority of your questions, but I wanted to clarify a few of them. The first question that came up is, does the bank have to be at 50% of the total project? The answer to that is yes and no. The bank has to be at least 50% of the total project cost when the loan project is deemed as a startup or a special use project. So like those hotels, gas stations, other single-use properties that Judd had outlined before. Those are the only instances where the bank or credit union has to be at 50% of the total project cost. Other than that, the only rule is that the SBA loan cannot exceed the bank or credit union's loan amount. So for example, if you have a borrower that really wants to put in more than the 10% down that is required, they want to come in with 20% because they want to carry a lighter debt load, but at the same time, the 504 is very intriguing to them because of the fixed below market interest rate. We would allow them to come in with the 20% down payment, and then the bank or credit union and the SBA would split the remaining total project cost. So it would be 40% of the total project cost is covered by the bank loan, 40% of the total project cost is covered by the SBA and CDC, and then the borrower would come in at 20%. Next question that came in that we wanted to further clarify is, does the SBA provide money for the construction draws? The answer to that is no. The SBA 504 loan program is really a construction takeout lender. So the bank or credit union would draw up a loan to cover the purchase of land and then also the construction of the building. They would fund and disperse the whole construction loan amount, and then the SBA would come in at the time of construction completion and then pay down your loan or take out the interim loan if you'd drawn it up where there's a first and a second loan there. Now, as a lender, my previous life was in banking. My big question would be, okay, so what about being stuck with the 90% if the SBA failed to fund? That's an excellent question. So we provide the approval up front before the construction is done, or before the construction even starts, rather. So you have the peace of mind knowing that we are going to come in and take out the loan. Now, the SBA does provide an out clause for themselves, which is called an adverse change. An adverse change means something went terribly, terribly wrong during construction, and now the SBA is unwilling to fund their takeout portion unless that issue has been cured. Now, I say that with a bit of trepidation that you're going to be scared and say, oh man, I don't want to do these because the SBA is not going to come in and take me out. Well, let me give you a little peace of mind that in the 38 years that Mountain West has been in business, that has only occurred 4 or so times. And those issues were huge. They typically were revolving around the company declaring bankruptcy in the middle of construction, or it was a single owner and that owner operator died during construction. And then others are, we had another loan with them and they stopped making their loan payment on that loan, the existing loan during construction. So you can see that with all the thousands of loans that we have processed in that 38-year history, we've only had about 4 where that became an issue. And we work very hard with the bank and credit union to resolve those concerns and help you on the front end to protect yourself. So by taking an assignment of life insurance to warrant or to guard against that happening if an owner operator died, or taking extra collateral during construction if it's really a business that you're worried about having some seasonality or issues coming up during construction. So no, we do not fund the construction draws. We come in and take it all out at the end of construction. Now, another question was, can I wrap in the equipment lending as part of my land and building project cost so that everything is on a 20 or 25-year rate? Or do I have to break it up where I do a land and building project at a loan of 20 or 25 years and then separate it with an equipment loan at a 10-year term and amortization? The answer to that is we can wrap in the equipment so that it's all just one pretty little loan package with the 20 to 25 years, as long as that equipment makes up a minority portion of the project. So if it's less than, say, half of the total project cost, we're going to be fine to wrap it in at a 20 or 25-year rate. I think that answers the majority of the questions. Travis, you and I had some back and forth on the question and answer. I sent you my phone number so we can talk about deal-specific questions. I think I answered it in my bit about, do we at the SBA fund actual construction draws? No, we're a takeout lender, but please feel free to call me. I've sent you my cell phone number and we can talk about those things offline. Outside of that, we really appreciate your attendance today. We hope we didn't take up too much of your time and that you found this to be informative. And like I said before, we will follow up with these slides to all participants, and then we will also be sending out the recorded video link so you can share it with others in your organization. Please give Judd and/or Mike Oliver a call on all of your loan questions. We look forward to working with you. We look forward to taking care of your borrowers, and we look forward to meeting you all soon. Thanks so much. Bye.